Happy New Year. Welcome to 2020. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is January 1st. Happy New Year to everybody out there. Hope you had a great holiday, New Year's Eve, and you're just watching football or hanging out, watching a little bit of hockey today. A lot of stuff going on the TV, of course. You got soccer, Premier League soccer, you got football, college football, you got some NHL hockey as well too. So hope everyone's doing well. So basically, I'm Randy Patrick, your editorial host with the truth of real estate market, speaking the truth of what's going on in the industry. That's my new tagline, I guess you could say, speaking the truth here. So again, January 1st, start off of a new year in housing. So we're going to review the most recent news that happened over the past couple of days. And the number one piece of news was, guess what? It was the last Tuesday, yesterday in the month, and that indicates the release of the S&P Standard & Poor CoreLogic Case-Shiller U.S. Home Price Index. So this came out for October. Realize for Case-Shiller, there's usually a 2-month lag and drag with respect to their data. It's a complex calculation. They look at sales pairs and they compare previous months, etc. So it's a bit of a calculation that they do. That's why we're usually about a month and a half to 2 months late with respect to what's going on in the industry. So I guess you could say the news is October had a 3.3% year-over-year increase from the previous October. So of course, October 2019 increased 3.3% compared to October 2018. That would make sense. The home prices are now over 15% above where they were back at the previous housing peak, which was July of 2006. So we're now 15.1% above that peak value. And I guess at the regional level, locations like Phoenix, well, they retain the top spot in the index gains for the fifth straight month. The Southeast region like Tampa, Charlotte, Atlanta all rose by more than 4%. So there you go. So we're going to talk about this now. So again, national index, as I mentioned, 5.1% from the peak. So we had peak in 2006, trough in 2012, and now we've just had appreciation. Even though it's slowing down, we're still getting a little bit of appreciation every month now on Case-Shiller, and it's up to 15.1% compared to the 2006 peak. So keep that in mind. When I look at the regional level, so Case-Shiller has the national composite, which was 3.3. They have a 20 city and a 10 city. We tend to look at the 20 city because it's sort of the major cities in the U.S. I'll go over their increases right now. I'll also post this as a link so you can go right to their website and you can download and look at this yourself. It's good information. So Atlanta had a 4.2% increase. Boston was 3.4%. Charlotte 4.8%. Chicago 0.5%, kind of low. Cleveland 3.3%, Dallas 2.9%, Denver 3.3%, Detroit 3.1%. Las Vegas, looks like Las Vegas only has a 2.3% increase. Los Angeles 2.0% increase. Miami 3.3%. Minneapolis 4.2%. New York a little bit shy of 1%, 0.8% increase. We have Phoenix leading the way, as I mentioned, at 5.8% year-over-year appreciation in home sales and prices. Portland was 2.7%. San Diego 2.9%. San Francisco came in at 0.4% negative. So San Diego actually lost value from this time, from October of 2018 to October 2019. So San Diego is the only one that dropped price. Seattle had a 2.5% increase. Tampa with a 4.9% increase. The overall composite 20 was a 2.2% increase across the board when you average it out. Now, what is interesting about this is that San Francisco was the lone city to post a year-over-year decline, and it's the first time to see an annual year-over-year decline since April 2012. So to me, that's kind of interesting. So that's our first kind of, San Francisco usually is one of the drivers and one of the most expensive places to live in North America. So they actually saw price decline, even though it's a small percentage point. It's still, when I always say it's peaked, and when it starts to turn, it's the start of something. So at some point in time, you peak. At some point in time, you start to turn and you start to decrease. So we've kind of seen that happen with San Francisco now. When I look at the composite index in the 20s here, we've seen year-over-year increases, but when I look at the month-to-month, so I'm not going to go through all of them, but let's suffice to say we're seeing more locations in the top 20 metro having month-to-month decreases. They gained so much in September and they gained so much in October, but September to October values did decrease as well. So places like Chicago, Cleveland, Dallas, Detroit, Las Vegas, Minneapolis, Portland, San Diego, San Fran, and Seattle all had month-over-month decreases in price valuation. So that's 10 out of the 20 top 20 in the top 20 index there. So half of those locations did see price decreases from month-to-month level. For me, I thought Las Vegas was interesting because Las Vegas has been kicking up a storm over the past year, and now it certainly is slowing down with its annual, and we're starting to see every month now that Las Vegas is starting to lose a bit of steam there. So that's interesting. And again, having half the top 20 index starts to shows me there may be some future trends going on right now. So please keep that in mind. All right, something else I want to talk about here. So with respect to, actually we'll do this first. With respect to home price increases in valuation, FHFA puts out their own report as well too. Federal Housing Finance Agency, that's FHFA, which really is the government, if you think about it, the agency, Fannie Mae and Freddie Mac, and they put out their information saying home price climbs 5% on an annualized basis last October. So I looked at this and thought, okay, this is interesting. Let's see what they have to say here. So home price increase in October, rising only 0.2% from the previous month, but up 5% from 2018. They're referencing October timeframe themselves. The FHFA monthly HPI, which is home price index, is calculated using home sales price information for mortgages sold to Fannie Mae or Freddie Mac. So there's the qualification there. We're only talking about government-based mortgages sold to these two entities. So because of this, the selection excludes high-end homes with jumbo loans or cash sales. So they're not included. So those two segments are not included in the information here. So therefore, might be a little bit skewed because you got Case-Shiller, who basically is talking about the entire sales across the board for October, whereas FHFA is sort of zeroing in on just loans that they're guaranteeing and backing themselves. So just keep that in mind. I think it's a little bit interesting when you see that. And there's I guess from how I extrapolate this. Those are government-backed homes, 3% down type mortgages. A lot of those are probably in the sub 250 marketplace, sub 300 marketplace there. So more on the affordable home pricing area as opposed to higher end homes. So that's the scoop on that. And realize that National Association of Realtors, so NAR puts out their numbers too. You've got Zillow that puts out their numbers. You've got CoreLogic that puts out their numbers. You've got Redfin that does analysis and puts out their numbers. So you've got 6 or 7 locations, or not locations, groups that are putting out sales statistics. So it's kind of tough to listen to who's saying what and what their sort of nuances are and how they calculate their pricing indexes. I just stick personally with Case-Shiller, 2020. I'll get it right at some point in time. With Case-Shiller, I stick with Case-Shiller. I've used that since they created it. To me, it seems to be the one that I like the most, and seems to be the most. I like the way they do their sales pairs, etc. So for me, I just use that as my personal index, etc. So also, pending home sales disappoint slipped to 4-month lows. So NAR, so National Association of Realtors, does put out a pending home sales index. It's a calculation that they do, and according to them, pending home sales rose 1.2% month over month for the month of November. Now, that's less than what was expected from NAR. I want to qualify this though. If it rose 1.2%, you're going to go, oh, well, gee, things are picking up. But realize that October's number actually declined quite a bit. So we sort of dropped in October, and if we rose a little bit in November, we're still low because October was a much larger hit to the pending home index. So, so just keep this in mind. According to NAR, favorable conditions are expected throughout 2020, though supplies still aren't sufficient to meet healthy demand. That's, of course, from Lawrence Yun, the chief economist of National Association of Realtors. Builder confidence levels are high, because we've seen and read that. So we just need housing supply to match and more home construction to take place in the coming year. Well, great, but where is the housing supply going to come from? Builders aren't building as many homes as we know that, and when they are building a lot of homes, the price points tend to be a little greater than the affordable housing segment or values, which is where we need the most amount of inventory. So even though they can spin it any way they want, which is, hey, confidence is great with builders, they're going to build more homes, but you know what, the homes they're going to build aren't going to meet the demands of the people who really need the homes the most. That's as far as I'm concerned. So keep this in mind as we hear how it's spun. And just so we know, the increase in the pending home sales index was led in the West, and signs were up 1% in the Midwest and up in the West, and they were down in the South, and they were down in the Northeast. So that's the scoop for the month of November pending home sales index. And for those of you not aware, the pending home sales index are not home sales. They're contracts, they're signed contracts. So I have a home that's listed on the MLS. As a seller, a buyer comes in, we go under contract. Great, we're in contract. It's marked to pending in the MLS as a status, and it's a future sale. So it could be 30 days, 60 days, even 90 days out in the future. And that's again indicative of future sales that may occur. A pending home sale status does not indicate that it will close. In fact, it could be canceled for various reasons. The lack of financing, or not being approved, or not appraising, whatever. So there's still some factors. So pending homes don't indicate 100% of the sales that are coming in the future. But we do look at that when we see less homes. If we see drops in the pending index, expect drops in the sales volume in the upcoming months. All right. This I found interesting. Americans are cashing out home equity with higher rates. So I guess a Wall Street Journal did a story here. They used mortgage data firm Black Knight Financial to get the data, and they took a look and said nearly 60% of the cash out refis that occurred in 2018 came with higher interest rates. The biggest share of that before the last financial crisis. That's the biggest share since the last financial crisis. So for now, you would think, well, if the rates are higher, why am I taking the cash out? Wouldn't I wait? Because we've seen this year with the rates dropping, almost 65% of the loans being originated these days are coming from the refinance market. So you would wonder why people would take them out when the rates were higher, but I guess it's not really that big of an issue, because they say the trade-off is worth it. While mortgage rates have crept up back at that point in time, they're still lower than what borrowers would pay if they tapped credit cards or home equity lines of credit. They're called HELOCs. So basically the bunch, and this is the interesting point here, which I think you need to take note of, a big chunk of the cash out refis was due to debt consolidation, specifically paying off a home equity line themselves or by rolling it into a first lien mortgage. So you're just taking old debt and then you're rolling it into your primary mortgage, or you might be taking cash out so you're solving some of those other problems and some debt. You actually have a higher mortgage now that you did back in the day or when you first took it out, but it was worth it to you to pay that off, and you've got your equity appreciation, you're tapping, so you think it's worth it. So after roughly a decade of rising home prices, homeowners are flush with records amount of home equity, which we do know because we see the Adam Data Solutions information that comes out every quarter or so, saying how much tappable equity there is across the board, and there's quite a bit now. But many Americans remain short on cash and are increasingly relying on debt to fund their lives. So nowadays, if you look at what's happening now, it's like a repeat of what happened back before the last housing and financial crisis. So people were using their homes as ATMs. That was kind of the joke. You got a little picture of a house, and the ATM machine, the card, you're taking money out of your home. That, of course, will remind some people of the years before the housing crash, when many Americans turned their homes into ATMs, using the cash for vacations, cars, and debt consolidation. So a lot of the times, when you're asked when you fill out your mortgage application, or your home equity line of credit, the banker or the mortgage broker may say, well, what are you using the funds for? Well, I'm going to do home improvement. Well, a lot of people took out money back in the day for home improvement, but it was actually being used for, again, luxury items, fun things, trips, debt consolidation, etc. So you've tapped that equity. Now you've got less going on. But I guess the comforting thought was, well, property values are still going to increase, because at that point in time the bubble hadn't popped and crashed yet. So people were always thinking, well, I'll make money next year. My home will go up 10% more, so I'll just make back what I took out. Or if nothing happens, if I sell, at least I break even. That was the concept. And I can tell you, I spoke to a lot of people who took their money out like that, who faced foreclosure and fell into foreclosure, either lost their homes via foreclosure or we did short sales for. And a lot of people just felt that the values would still continue to rise and they'd at least break even as a worst case scenario. Well, we know that did not happen. All right, so realize that there's a big difference though. So the difference in the 2006 amount of equity that was stripped out of the properties, it was about $350 billion back in the day, and we're looking maybe okay, 100 billion was taken out back in 2018, and as of the first 3 quarters of this year, of 2019, it was 66 billion. So if you think about that, we're looking at almost 100 billion being taken out again. I'm going to say it's going to probably top 100 billion because I know that the past couple of what's going on in the past quarter, we saw many more refi applications being generated. So I'm sure we're going to overcome 100 billion again. Now we're 15%. If we go back to Case-Shiller, we're 15% higher in value. So there's more money, cash to be taken out, which is interesting. It's not the same chaos as it was back in the day, but it's still precarious, which it still goes to show that people are taking money out of their properties to live or to fund their lifestyle or fund their debt or consolidate their debt. And to me, when people take, and I've said this before, I always tend to repeat myself, but when I've said this, when people take money out of their properties, it's almost an indication that they're not going to put it back on the market. They need the cash now, so they're going to sit in their house. So they're susceptible to price declines. And if you think about it, well, if you have to sell your house, what actually happens? Well, traditional sales, you use a real estate agent, you're going to pay on average 6% commission. You're probably going to pay about 2 to 3 percentage points of the sale on closing costs and document stamps to transfer the deed and things like that. So we're talking maybe 8 to 9% off the top. Then you pocket your money. Well, guess what? You do a cash out refi. If the market changes 5 or 10%, you're precarious now to sell your home. You've lost a bit on the home, and now you got to pay the closing costs and commissions, and you're stuck. So what are you going to do? Well, can if you're at that high loan to value on your refinance, your cash out refi, you're going to be stuck. Either you're bringing cash to the table to satisfy the loan when you close, or you can't close, and therefore you can't actually sell, which may cause future problems. So just keep that in mind. To me, this is another telltale sign that the past couple of years we're stripping more out of our properties as the value grows, and that's when you're stripping money out at the peak values. To me, that's a not a good thing. It's a negative sign. It's a good indication that the future issues will be apparent for these people, and they may be stuck in their homes or having to do other solutions if they want to move out from their property, which may not be favorable for them in the end. So just keep that in mind. Again, another thing that, to me, when I look at it, going just like the last housing crisis. All right, one thing I want to note here, last point I'd like to make, fraud risk on purchase mortgages climbs for the first time since March. So there are different groups that put out fraud indexes. This is from First American. They're obviously a title company. First American's loan application defect index indicates the nation's mortgage defect risk increased, but only for purchase mortgages. So, when values go up and values are high, prices are rising, we tend to see mortgage fraud raise and come into place now. And that's just nature of what happens. So this was being tracked sort of at the end of the last housing crisis. So when we saw, we'll say rises in valuations, there'd be different groups that would say we see, fraud activity or the potential for fraud activity increasing. So, but it's interesting though that they see that in this case, they're reporting a decrease in refinance fraud. So that's, of course, different, but an increase in purchase fraud. So refinance, if you think about it, you're already in your home. You've already got title to your home. You've been there for, a couple of years, if not longer. You're going to refi. So the amount of fraud that can possibly happen is limited. Now, when you're purchasing a home, what do you do? Well, there could be name fraud. There could be usage fraud. What's usage fraud? Well, you're buying a home as a primary residence, but you're actually going to use it as a rental property. So people that are doing so are actually getting higher loan to values and more we'll call it more financing like dollar values and lower rates for not the intended purpose, and that's potential more for fraud. So just realize I've seen a lot of this over the years, and it's just interesting to see that every so often we see a spike in mortgage fraud and risk. So it just goes to the territory. We're always going to have that. It will ebb and flow with value. So having said that, that's it for the first video of 2020. Thank you once again for the views supporting my channel. Thank you for the comments and the likes in the video. Please share with your family and friends. That would be great. If you're not already a subscriber, please do me a favor and subscribe to my channel. Certainly help my channel grow and get me out there a little more into the general public, which I'd appreciate. If you need more information on my real estate training programs, please drop me a line. Send me an email. You've probably seen my email cycle up on the screen here. Send me an email. Put your phone number or how I can reach you in your email so I can text you and we can figure out a time to talk. So please do that. Realize most of the people that send me an email forget to put in where I get a hold of them. So please put your phone number in. And again, if you're looking to purchase a home in this area or an investment property, please drop me a line as well too. I can help you with that. I can help you find a place. I can help you with mortgages. I have great connections in the mortgage industry. And if you're looking especially for investment, I'm coming across more and more off-market properties nowadays that are either buy and hold or fix and flip opportunities. So if that's interesting to you, give me a shout. And please realize that you got to have the wherewithal to be able to handle the project. What we don't do or engage in is I have a property that's great that you're putting under contract and you're trying to wholesale to somebody else, because these are already being wholesaled in the first place. So can't be doing that. Just give you a little tip there. But if you want more information on what's going on, because a lot of things, December just suddenly spiked in this location down here for a lot of activity. So I want to keep running this. It's pretty good. So the opportunities there, and just again, drop me a line. So having said that, thank you for today for watching, and we'll look forward to another video before the week is up. Take care.